Hi, good evening, everyone, and welcome to today's webinar, Beyond the Rate Cuts, the Future of Private Credit Investing. My name is Janet Liu. I am the VP of Investment Advisory at Stashaway. We are thrilled to have you all tonight as we explore the evolving landscape of private credit investing. Before we dive into the content, I would like to remind you that the information shared today during this session is for educational purposes only and is not intended to provide any specific financial advice. And if you have any questions regarding your personal situations, please consult your financial advisor. And I'm delighted to introduce our expert speaker today from Hamilton Link, Corinne Code, Managing Director. Corinne has over 20 years of experience in alternative investments, and she's here to share her deep insight on private credits. Corinne will walk us through Hamilton Link approach to private credit, markets, current outlooks, and strategies that investors can use to optimize their portfolio. And after her sessions, we will have a Q&A time for you to, so feel free to submit your questions throughout the webinar in the Q&A box. Let's quickly go through the agenda today. I will start with a brief introduction to Stashaway Reserve for those that you haven't heard about us yet, and then we are about also offering and a brief introductions to what alternative investments. Kareem will present the insight on the private credit market and opportunities for investors. We will then close the sessions with Q&A where we can address all your questions. So let me take a moment to introduce Stashaway and what we offer. Stashaway is an Asia leading digital wealth managers with a presence across Singapore, Hong Kong, Malaysia, Thailand, and Dubai. We provide a robust platform that delivers personalized information solutions to meet the needs of a wide range of clients. And particularly at Stashaway Reserve, we also include exclusive access to alternative investment. So we offer a full range of investment portfolios that meets diverse needs of our clients. Our core offering including general investing portfolio, which actually designed to offer a diversified exposure to global markets. Its SRI, which is the Stashaway Risk Index of 36% portfolio, has actually generated an impressive year-to-date return of 14.6% as of early September. We also provide a flexible portfolio, which for clients who have more control over their investments. We have thematic portfolio, which you can tap on the long-term trend like healthcare innovations, clean tech, consumer technologies, or alternative investments for research customer for further diversifications. Additionally, for clients who look for stable, low-risk options, we offer cash management portfolio like Simple Plus, which offer around 3.6% to 4% yield to maturity, as well as US dollar cash yield. And our recently launched income investing powered by JP Morgan's actually has provided access to well-diversified fixed income products. So, as Stashaway Reserve, one of the unique advantages of investing with Stashaway Reserve is that we will be able to provide you the personalized wealth advisory service. Each investor has access to a dedicated MAS licensed wealth advisor in Singapore or SFC licensed wealth advisor in Hong Kong. They will provide you unbiased advice not only for just Stashaway's portfolio, but on your entire wealth plans. We work closely with you to review your investments and help you achieve your financial goal. Our platform is safe and secure. Clients' funds will hold in secure trustee accounts, and we simplify access to institutional grade strategy that normally only available to institutional investor. Okay, now let's take a closer look of alternative investment. Unlike traditional investments, which trade on the public markets are highly liquid, alternative investment like private credits, private equity are private and tends to have a lower liquidity. However, this is precisely what makes them attractive. They are less correlated with the market fluctuations and provide a layer of diversification and stability to your portfolio. For example, traditional investment price intraday, while alternative investment like private credit usually priced monthly or quarterly. And these investments are often accessed only to institutional investor, but now we'll be able to offer to our client as statutory reserve. But why should you consider allocating part of your portfolio to alternative investment? According to research, institutional investors typically allocate 23% of their portfolio to alternative. This is because alternative investment actually offer a broader diversification and provide an improved risk return profile to the investment as well. For private credit in particular, this provide a potential for stable cash flow and downside protections, making it a very powerful addition to both fixed income and equity heavy portfolio. This slide highlights a very important point. As you can see on the right hand side, if you're comparing private credit internal rate of return IRR, which is the dark blue, compared to the public credit IRR, which is the lighter blue, this is the performance annualized for the past decades, 10 years, 15 years, 20 years. As you can see, they have been providing a very consistent return across a different tenure. Despite the market volatility and economic challenge, private markets actually have shown a very good resilience, particularly during the tough time. In this slide, you'll be able to see actually private market has shown to be performing very well, particularly for developed market buyout on the first column, this histogram, and then also private credits. This is the lowest 5 years annualized performance from 1995 to 2020. So these two asset classes has never had a negative return over any 5-year stretch during this period. Now, one of the key advantages for private investment is their ability to deliver a better risk-adjusted return. As you can see from this slide, using private credit as part of your fixed income allocations, we started from the most right-hand side. You have high yield, bank loan, bonds, equities. But when you started to replace some of the fixed income asset allocations to private equity, as you can see, the total annualized return has improved, the standard deviation has decreased, it effectively has improved their Sharpe ratio. So using a private credit as a plus sector in the fixed income allocation has historically meant to both higher return, lower standard deviation versus to a standard 60-40 bond portfolio. Now, as StashAway, we provide assets to this asset class to those who have signed up as a reserve clients. And typically for this asset class, if you're at some traditional provider, the minimum requirement would be 250,000 US dollar. But at StashAway, we've been able to make it significantly lower to access. So we also make sure that the funds are securely held in segregated trustee account, which provide extra layer of security and peace of mind. And now, without further ado, I would like to pass the floor to Corinne Ho at Hamilton Link, who will be dive into opportunity and strategy within private credit. Over to you, Corinne.
Thank you so much, Janet. I feel like you've covered a lot of ground, so thank you for the invitation to be here today for this webinar. And a big thank you to everyone who has dialed in. I think the first and foremost, I would like everyone to give a pat on your own back, because as we talk about investing, I always thought the most important thing is to invest in yourself. So today, all of you have chosen to invest an hour of your time to learn more about investing, particularly in this case, private credit investing. So I hope you will get a lot out of it, and there'll be time for us to cover some Q&A as well. So I'll start to share my screen over here. So as introduced by Janet, my name is Karin Koh. I am the head of Southeast Asia for Hamilton Lane. So here today, we would like to spend some minutes to talk about three things. One, what is private credit? Second, why private credit? And third, why private credit now? Because as some of you might have seen, and I think it's also the title of today's webinar, we have seen that the Federal Reserves of the US has just cut the base rates by around 0.5% 2 weeks ago. So these are the three areas that we will be covering today. So let's dive in. But first and foremost, before we start, I would like to share a little bit about Hamilton Lane and who is Hamilton Lane, just to give you a little bit lay of the land of where I come from. So today, Hamilton Lane is one of the largest private markets manager in the world, with around 940 billion in assets under management and supervision. So three things to highlight about Hamilton Lane for you to take note of is firstly, we have been investing in the private markets for 33 years. So that's actually since our founding. I think that's incredibly important because to invest in public markets is relatively accessible. But for private markets, you actually really need to be a specialist for a long time to have that network, to have that knowledge base, to have that data. Secondly, is that we are one of the largest deployers of capital or investors into the private markets. So last year, we invested around 30 billion US dollars into the private markets. So this really gives us a lot of scale, a lot of influence to be able to negotiate and to source the right investments for our investors. And last but not least, pertaining to today's theme, which is in private credit, we have been investing in private credit for more than 20 years. And we also have a pretty sizable investment into private credit of around 70 billion US dollars. And this is across senior credit, which we're talking a little bit more about today, but also across the credit spectrum, including in more opportunistic credit as well. So let's dive in. So firstly, what is private credit? So maybe about 20 to 30 years ago, if a company decides to borrow money for its business expansion, it would go to a bank. So if the loan was relatively small, the bank would underwrite the loan and disperse the loan, and all is good. But if it's a relatively larger loan, so what the bank would do is to assess the credit, and then it would turn to other lenders to share out that lending. And so we call it syndicated lending. So essentially, it will come up with a term sheet and go to tens, if not sometimes 100 lenders to share out this in a syndicated loan basis. Now, so that is an intermediate way for a company to get financing. So about 10 to 15 years ago, there is a market that is arising because especially post the global financial crisis on private credit, where the borrower is actually now put directly in contact with the lender. And why would borrowers now want to, which will be in the past, that past 10 or 100 lenders out there, but they will be intermediated by a bank. But now, in the past 10 to 15 years, the borrowers are now going directly to the eventual lenders to them. And why would they be doing that? There's a few key reasons. One is actually the certainty of the loan. So when a company wants to get financing, usually they're trying to do an acquisition or business expansion. In other words, they really want to see that there is a certainty that the financing is there for them. So within private credit, that certainty is usually higher because comparatively to a syndicated loan process, it can take a couple of months even for a company to know what is the terms or what is the rate that they're getting versus in private credit where it's usually one or two or three lenders. So it's just faster and more certainty of execution for them. And secondly, it's the greater ability to customize. So as mentioned previously, maybe the loan is or term sheet is going out to tens, if not hundreds of lenders in a syndicated basis. So you need to find the denominator of terms that works for everyone. But a lot of times then the terms may not work as well for the borrowers or it's not as customized to them. But in private credit, usually with the small group of lenders, they are able to usually be specialists in that type of lending or understand the company's circumstances better and being able to tailor that more greatly. So that in a nutshell is what that private credit, especially direct lending, is about. But what I'm going to show here on this chart is that there is really quite two distinct part of private credit. So on the left-hand side, what you will see is primary or performing credit. So this is what we mentioned about banks, borrowers actually borrowing directly from private lenders. And you can see here that this is first lien, senior secured. This, in short, is the top of the capital structure. If a company unfortunately runs into any challenging business situation and needs to be liquidated, these are the people who are top of the capital structure or first in the queue to actually be paid back in terms of their loan. And then we go to second lien, mezzanine debt, and then preferred equity, and then equity, which is really shareholders. So the analogy there between first lien and second lien is almost like when you are taking out a mortgage on your house. When you take on a mortgage on your house, the bank that give you the loan first is going to use the value of your house as the collateral. So if you didn't pay up for any reason, they are the first to seize your house and sell it. And because the loan is usually much, much smaller than the value of your house, they will usually get all their money back. The second lien lender usually gets what is the remaining value of the house. So they are getting a little bit riskier in terms of the lending. So on the right-hand side is what we call secondary or distressed lending. This is where lenders are lending to companies that are in a more stressed scenario, either because of their temporary cash flow issues, liquidity issues, maybe their slight challenges if their sales or business plan. But here you can see in terms of commensurate returns, investors or lenders are taking more risks, and therefore they usually require higher rates of returns as well. So I would say that today in the market, more prevalent has been the primary and performing side, but there has always been also the secondary and distress side. But today, I think we are talking a little bit more about on the platform will be more on the performing side, especially on the first lien senior secured side of the spectrum. So some investors may also be thinking or maybe have exposure to private equity. I think on StashAway's platform, as Janet just described, you can also get exposure into private equity. So what are the key differences between private credit and private equity? So there's a few things here on this table, but I'll just highlight three. So one is what I mentioned, because of the higher certainty to get repaid, you are first in line to get your money back when a company goes south. So lower risk, but commensurately also lower return. Secondly, very attractive in terms of characteristic of the asset class is cash payments. So when you lend money, you usually get regular repayments. And therefore, private credit as an asset class usually has a distribution component. So today is really more at the high end. So I would say around 8% distribution has been the norm. And investors usually like that, especially investors who like yield or income profile. The third one to highlight in terms of difference, on the cash pay side, on private equity, usually the distributions are in terms of dividends. For private equity, usually there are distributions or dividends, but it's just less regular and less predictable. And thirdly, it's the average hold period. Usually, investors of private credit have a shorter hold period. So they will hold the loan typically for 3 to 5 years. Whereas for private equity companies that you're buying into, usually hold that equity position for 5 to 7 years. So I've covered about what is private credit, and happy obviously to take questions on the what, but now moving into the why of private credit as well. So private credit today is about a 1.6 trillion US dollar industry. So that's actually rivaling the size of the US high yield market, which I think some investors are familiar with as well. So I think this is a different way to showcase what Janet actually mentioned earlier, which is that over the past, I would say, couple of years, definitely in 2022, earlier part of this year as well, you have seen that when there is a downdraft in public equity markets, traditionally investors would have thought of their fixed income exposure or public fixed income exposure as having a opposing effect, a diversification effect. So basically, bonds should go up when equities go down. But in the two episodes that I just mentioned, the stock bonds correlation actually increased, meaning that when equities went down, bonds valuation went down as well. So diversification was lower than some investors might have expected. So what should investors do? I think from a portfolio construction perspective, if investors have just public equity and bonds, I think that's good. There's some diversification. That is the first line over there. But on top of that, if you look at the second line where we introduce just a tiny bit of private credit into the portfolio of around 2%, here you will see that the return actually goes up and the risk as measured by standard deviation actually goes down. And as you go down this table with more percentage allocation to private credit, you see the same phenomenon. Return keeps going up and the overall risk level of the portfolio goes down. So this really illustrates that adding private credit has diversification benefits for the portfolio. And this is, I would say, what we call the last free lunch in investing, which is that as you add asset classes that are quite different or behave quite differently from what you existingly have, you should be able to get more efficient portfolio, which leads to higher risk, higher returns, and actually lower risk. And this chart shows us more specifically on private credit as an asset class. And it shows a pretty long period, which is around 22 years. On the dark blue bar is actually the private credit returns over this past 22 years. And in the light blue dots, these are actually private market equivalent of leverage loan index, which is a proxy for public credit markets. So here you see that across all these 22 years, the dark blue bars have actually outperformed the light blue dots. So private credit in itself has offered very attractive returns to investors. And here you can also see these dotted lines. So the dotted lines really represent that if an investor has skill or a manager has skill to pick above average investments within private credit, then they can actually stand to outperform even more. So investors like that, generally speaking, they like more attractive returns than what they might get elsewhere. But I think more investors were concerned about the risk, and we're all concerned about risk because our money is, after all, hard earned. So this chart really shows the risk, and I think Janet, thank you for borrowing one of these slides there. And I think this chart is really showing different private market asset classes and across the past 20 plus years. The up market here really shows what we call up market when equities market are positive, and down markets means that when public equities market are negative. So you can see that the orange lines are actually the average return under the two types of scenarios. So you can see that on the downside perspective, private credit has been quite resilient because the average return in both up and down markets are still positive. But more importantly than that is not just the average, but if you look at the dark blue bar and the light blue bar, they capture the top two quartiles and the bottom two quartiles of returns. And you can see even if you were so unfortunate as to pick the lowest quartile returns, it is still a positive number. So that and you can see that comparatively to other private market asset classes, the bars are shorter. So the dispersion are actually narrower. So you have less risk of picking a bad investment as compared to the other private market asset classes. So these are all very attractive characteristics of private credit that investors have liked over time. So this is the chart, I think, that actually was the one that Janet has shown. But this is really for the investors who, you know, go to bed every day thinking about what if the world ends, right? Show me like the worst case scenario, which is like the lowest 5-year return in past 28 years, which is a very long time to look at. So as what Janet mentioned, it is still a positive number. So just as we mentioned about the fact that maybe private credit won't always give you the highest return compared to private equity, but from the downside perspective or the worst case scenario basis has been actually very, very resilient. So we covered about what is private credit, why private credit more broadly, but now we're actually segueing to why now, especially in the era of rate cuts. So why now over the past couple of years is an easy answer. So why now? You can see that these are actually the base rates. So SIBOR and SOFR senior secure overnight financing rates. These are basically base rates on top of which loans are priced. So the total yield of a loan is usually the base rates plus spread. So two components. So since the late part of December 2021, obviously we've seen this steep rate hike cycle, and therefore the base rates have gone up to a level of above 5%. So add on top of it the spreads above the base rates, which is how private credit loans are usually priced, that's usually about 5 to 6%. So total return for investors over the past couple of years has been above 10%. So therefore, I think there has been a lot more interest in private credit as an asset class because of that attractive total return. Now we come to our topic du jour today, which is about the fact that rates have just been cut by 50 basis point or 0.5% 2 weeks ago. So how has that actually impacted the SOFR rates, the base rates? So today the base rate stands at 4.96%, so a notch lower. And add on top of that spread, you can see that today, even with the rate cuts, at this moment in time, private credit is still very attractive. So you add like around that 5% handle plus 5 to 6%, you're still getting teens, low teens return. But the bigger question is, which I think is also the title of today's webinar, is what about the future? So where do rates go? And is this still an attractive asset class? So we try to take out our crystal ball and look into what rates would be like. But there's one thing that I think everybody took away from Jerome Powell's statement, which is that rates will go up over time. So quote unquote over time. So immediately, I think the forward curve that people predict very steep rate hikes that is actually done much more quickly, immediately the expectation has moderated because the Fed has indicated or guided our expectation that rates will actually stay higher for longer and that it will be a much more moderate rate cut cycle. So we look at today where we are, which is around a SOFR rate of around 4.9, or say we are around this area. We expect that the rates will trend down over the next 2 to 3 years to what the Fed or the broad market will see as the neutral base rates, which is widely believed as between 3.5 to 4%, which is the long-term average before the past 10 years, which was abnormally low rates. So the market and the world is not expecting the rates go back to zero or close to zero. We are expecting normalization to around base rates of 3.5 to 4%. So considering that in private credit, we do actually still expect that the spreads above the base rates can stay stable at around 5.5 to 6%. We then expect that even over the longer term, private credit returns can still be achieving that 8 to 10% over the longer term, even without applying any fund level leverage. So I think that in itself is still very attractive. And more importantly, many investors were actually getting to a point where they were worried about the D word, which is default. So because rates are high, when companies have higher rates loans on their loans, they actually pay out more of their cash flows to finance their loans. So it is expected that defaults will tick up. So the fact that actually rates have started to moderate, it's actually a good thing. So now that there is obviously as lenders, you want to get more yield on your loan, but you also don't want to kill the golden goose that's paying you your dividends and distributions on your loan repayments. So we are now closer to striking a balance between attractive rates of returns on private credit and being actually moderate and actually conducive to companies in running their business on a day-to-day basis. So on the top chart here, what you'll see is actually the default rate over time. So the orange line here shows the long-term average default rate in the leveraged loan market, which is actually around 2% historically. Today, where we are at is at the dark blue line, which you can see is actually still well below the long-term average. But actually, as we see now, slightly trending down. So we do see that there is potential for default rate to tick up slightly over time, but for it to trend down to almost around the long-term average of 2 to 3% in 2025. So overall, the risk, which is personified by the default environment, it's actually relatively moderate, and we believe will be more moderate going forward because rates have actually moderated. So all in all, we think that this is actually a very healthy environment for private credit. But how do we further moderate or to reduce the risk in as lenders of as private credit investors? So we try to look at a lot of deals. So I think the thing about managing risk is that if you see only a small number of deal volumes or loan volumes and you do have to do all of them, then you start to lose the discipline in terms of selection. So you are not saying no to the worst investors. Private credit is saying no to the bad deals, right? And you're trying to lend at a healthy rate. So at Hamilton Lane, here we can see that the deal flow that we are seeing is actually extremely healthy. And you can see that over the past years, we have an average annual growth rate of deal volume. So the number of loans that we see of 26% growth over this period of time. But just last year, though, on a year-to-year basis, we actually seen that deal flow increase by 68%. What does that mean in very practical terms? This means that these allow us to see so much different deals, different loans, so many different borrowers that we can afford to be more selective. So you can see here that since 2015, we have seen more than 200 billion deals. We have selected only 7%. So it is really missing or avoiding the deals that aren't really looking that good, the borrowers that are very marginal, that allows investment discipline, underwriting discipline, coupled with the fact that at the bottom here, I think we illustrate some of the investment process, which is around sourcing, screening, prelim due diligence, full due diligence, portfolio monitoring, that needs to be a very systematic and robust process of investment for us to continue to stay disciplined and true to writing or lending only to the best borrowers. And as mentioned previously, I think in one of the previous chart, here you can see, I think, some of the benefits of that, which is that at Hamilton Lane, we do see that our first lien credit track record has been fantastic, has been excellent because of what we mentioned, very, very selective. The asset class has been doing well. The default rate is 0%. So over the past 20 plus years, I think that's a tremendous track record and really points to the fact that this is the benefit of a disciplined process. So all in all, I think we are ready to head into some of the Q&A. But before I do that, I think just a few key points to summarize. One is that, yes, rates are coming down. I think we are starting to see some rates normalization to the neutral rates, but total returns in private credit are still expected to be attractive. Secondly, we see that the risk as being more moderated. We see that the default risk being actually quite moderated, in fact, even more balanced now that rates are starting to come down as well. And lastly, yield pickup. So the key benefit of private credit is really providing diversification to what might be a public markets 60/40 portfolio, but also a yield pickup compared to public credit market or public fixed income market. Historically, we have seen a yield pickup of 1 to 3%, and we expect that to continue going forward as well. So with that, I'll wrap up my presentation and take some questions.
Yep. Thank you so much, Karine, for your insightful presentations. Yes, we are now going to move on to the Q&A. We actually received a couple of the questions throughout the session. Let me quickly look at it now. A moment. Okay. Okay. Okay, so I know you have shared earlier that about the default rate. So we do have a question from Ed mentioning what is the rate of default. I would assume that it really depends on the different seniority of the underlying bonds, right? I mean, the loan.
Yeah, that's right. I think what I have mentioned just now in terms of long-term default rate of the asset class, and this is across first lien, second lien, across the loan market, that's around 2%. Then that in itself is already generally better than the public credit market. So generally, private credit has a lower default rate. More importantly, it has a higher recovery rate, i.e., if a default has been triggered, how much on a dollar are you collecting back? That generally is much higher for private credit than is for public bond market. And these are really because of the reasons as mentioned, because as a smaller lender group, it's much easier for them to discuss, negotiate, and help the borrower if they first started to run into some challenges and issue. It's like, and if you offer help and you tailor make the investment early, the loan early to fit that particular borrower, generally they are able to recover faster and start to repay again. So generally lower default rate, higher recovery rate, but specifically to private credit, especially in the first lien side, it's actually lower across market, lower than 2%. First lien has the lowest default rate, so you can take that as a pretty low number. But I think, again, as mentioned at Hamilton Lane, that's even lower. So we actually have it as 0% on the first lien side.
Okay, so for Hamilton Lanes, basically from the first lien side is so far historically has been zero. Okay, that's good to know. Actually, there's another question because, in particular for this tonight, with the interest rate looking to decline, obviously in the public fixed income, the bond price will go up, which has a price appreciation. But you did mention that a lot of private loans are actually is a floating rate. So how would that then be? Does that mean that private credit would not be enjoying the price appreciation, or how does it? What's the relationship between the interest rate and the underlying price of the private credit?
Yeah, I think fixed income have fixed coupon rates, and as a result, there is a inverse relationship between interest rate and price. So, however, I think where people are trying to get into public credit now is they are really trying to lock in a certain rate before the rate falls. And this actually has an element of you're trying to fix the interest rate. You're going to invest now and hold it to maturity. Private credit is different. As loans, as we all, those of us who do take mortgage, these are fully floating rate for the most part. So usually the returns is based on the base rate, which is floating, as you can see in terms of the base rates plus a spread. And that spread has been quite attractive. Again, I think there is the question of like, what would happen when rates drop to 2% or 1%, etc. So I think two things to note here. One, I think that is not the base case. The base case is that and before it gets there, I think inflation will already get out of hand because there are actually so many inflationary pressures that I think before we even hit neutral rates, the likelihood as actually monetary policy will start to tighten or rates will start to go up again. So going below neutral base rate of 3.5 to 4%, the chances are actually relatively low today. Secondly, if you look for like pound to pound in terms of yield on like a corporate bond versus the yield on a loan, typically and historically, you actually seen like it's still providing a yield pickup. As I mentioned, historically, that has been like 1 to 3%.
Okay, great. So thank you sharing that. Okay, so I I think there's a question of how low will the distribution yield drop if the US rate drop to say 2%. So you have mentioned that that's basically not the base case, that's what you can imagine. But then maybe we can talk a little bit about what are the typical private equity or particularly maybe even evergreen kind of options of product would be what kind of features that it does typically like. So because I do see a lot of questions that coming in to have a very specific way to look at it. So maybe we can, have a general idea of one of those option amount because private credit is a big asset class. Like there are different form and shape and size. There will be like very illiquid. There will be some of the relatively more liquid. Some of them would be focusing on different
Mhm.
the seniority. So maybe we are making some sample
Yeah,
as a reference so we can easier to answer the questions for the audience today.
Yeah, happy to do that. So as I mentioned, I think today we are a little bit talking about the performing side of private credit, especially specifically to direct lending, first lien, senior secured. We actually expect that over the cycle, the returns, the yield on this type of investment should be between 4 to 8% over the cycle, and total returns of between 8 to 10%. So regardless, and that's over a cycle. I.e., we actually think that on the low end, that's 4% yield, 8% total return. On the high end, it has gone obviously higher than that, but over the cycle, I think that should be the type of returns profile that investors should be
Mm-hmm.
expecting.
So basically, what we're trying to say is like, regardless of the rate cycle environments, then because of the nature of the private credits, this kind of loan, that number one is a floating rate, and then also if you're choosing the right seniority, the performing side, then we are looking at around 8 to 10% kind of return. Great. Michael actually asked, are the return on the slides US dollar denominated or Sing dollar denominated? I think both like for my side and for Korean sides are all US dollar denominated. And typically for private credit that maybe Korean also can share a little bit for the market wise. Usually my understanding is like the US market and subsequently European market would be relatively more developed. So and it's one of the reason why a lot of offering in US dollar term as well.
That's right. So I think the returns there are denominated in US dollar. Obviously, for yield, then that doesn't matter as much because there's a percentage, but I think it's also total return that makes a difference. But as I mentioned, private credit as an asset class is the largest and most liquid in the US, and that's about I would say 3 times larger than European private credit space, and then Europe is about 3 times larger than Asia private credit. So in terms of balancing and making sure that we're investing into a liquid, deep, and well-developed market with good bankruptcy, rule of law, regulation, etc., um, we usually invest across US and Europe, maybe in that proportion of 3/4 to 90% 90%, right? Call it 75 to 90% in the US, and maybe about 10% to 25% in Europe. That would usually be a standard setup for investing into developed market private credit.
Mm. So this also answer Kisan's questions whether this lending are only within US market only. So as what Corinne has shared, the standard composition is usually like 75 to 90% US and 10 to 25% European, as those develop bigger size private credit investment fund. Um, so there is okay. So there is another question. This is actually quite interesting. As so it sounds like after the whole presentation, like Janet and Karen both say that like this private credit is like low risk, high return, good yield. Does that mean that it is very, very safe and supposed to be meant to be a conservative investment?
Yeah, I mean, firstly, where's the disclaimer slide for Janet, but all kinds of investing does have an element of risk. But I think in the scheme of spectrum of risk, I would say that if you invested into a company, if you invested in equity, you have all the equity upside. So if a company, it does very well, you can be like 2 times, 3 times, etc. But you can also be zero, right? That's actually the first loss piece for investors, usually equity. But credit is firstly senior secure. It's the safest part with to invest within a company
Mm,
because usually the way that private loans are set up, we look a lot at the loan to value ratio. And typically, we give loans that are of the size of around 40 to 50% of the company's enterprise value, which
mm,
means that something must go very, very wrong. So the company valuation halved or more, and then it starts to impact the credit lender. But in most circumstances, that does not happen. So this is how we typically think about it, which is how much would it take or impairment of the company you take before you are impacted as an investor, and that is usually the safest for the first senior secure investor.
this is a very long, well covered answer. So to answer one of our audience answer is that it is comparatively low volatility. And then, but like what Karen has mentioned, all investment has come with the corresponding risk. And one of the risks that for private credit is because of it is private listed, is not public listed, so liquidity is one of the issue. But because of the market has been developed very rapidly, so we also see a lot of demand from the investor side, and then they also try to give feedback to the provider, and as well, you will see a lot more product that actually, or the funds that come with like some uh, uh, a window for people to do liquidate or like have a shorter committed amount. So say for example, like a year's, and then after a year, there will be no penalty or the no special charge, and then will give you a quarterly or monthly kind of exit window. So there is such a offering out there, which you just need to find out more. But today is more talking about the underlying investment. So I think that's actually answer one of the question of Tan Me, that like the liquidity of the private credit could be low. So when would you consider a good timing to enter or exit the private credit to get a relatively better deal? This is a very interesting questions, because I think the concept has to be to be aligned first. Maybe Corinne, you can help me on this.
Yeah. I mean, like, absolutely. I think, people want to get in low and like sell high, buy low, sell high. That's supposed to be what people do in investing. But I think in private markets, particularly, we tend to think about investment in longer time frame. So despite the fact that Janet mentioned that some of these investment vehicle allow investors to be able to invest and redeem on a monthly or quarterly basis, but the average recommended investment period is really to hold it for a longer term of at least 3 to 5 years. So, is there a good time to enter into private credit? We would argue actually that any time is a good time because, as you saw, over the longer term, it has a premium to public asset classes. If you don't have a better place, except to stash it into your under your pillow or into checking accounts, etc., then you're looking for that premium above what you can get in public markets. Then yeah, I think that has shown that if you have the patience, you generally get rewarded there. So I would recommend not to time it too much just because you do get that premium over time if you have the patience.
Okay. I think there's this in, let me go through, make sure I don't miss any people's questions. Okay, you have appreciation, US dollar, okay. And okay, what is the count of credits that the fund is invested into right now? Okay, so we don't have a specific target product that we are talking today, but in general speaking, maybe when you, Corinne, you can share a bit example or like
So
some,
yeah,
yeah,
absolutely. Typically, we invest between 50 to 100 loans, so that allow investors to achieve very good diversification. Because if you think about a single company exposure, that's as low as 1 to 2% of any portfolio there. So we would recommend a more diversified
right,
approach
right.
there.
So if you like 1 to 2% exposure, touch wood, huh? If it is really go, when default, then you're talking about the total portfolio like losing 1 or 2% of your principal, which is considerably uh, uh, on a conservative side. So there's another audience asked how much should I invest in minimum. So I guess this question you can ask your financial advisor, and feel free to reach out to. I share a screen that there's a QR code. If you're in Singapore, you can scan on the left side, and you're in Hong Kong, you scan on the right side. And then, okay, there is this one more, two more last questions. But typically, the default rates for the middle and small company are quite high. Does Hamilton Lane
Yeah,
manage this
that's an
quite?
excellent question. I think it's back to, I think one of the last slide I shared, which is that if you look at typical, you're investing to average, you're investing to everything that you see, then you're getting average default rates. So the key is to see a lot of different deals and invest in little. So you're really very, very selective. You're never compromising your underwriting standards as a credit investor. I think that has been the key. And secondly, I think to do that over a very large volume of deals and companies and loans that you see, you definitely need a like very long-term investment process, very rigorous process where you have multiple steps. I think we just shared about that investment process of like sourcing, pre-screening, due diligence, ongoing monitoring. So all these are sounds a little bit boring, but like credit is a boring thing where we think that boring is better in private credit, and we try to stick to very try and test the very rigorous, systematic manner and try to see as many deals as we can.
Wow. Yeah. So I think also Corinne also shared the graph earlier that given private credit has been outperforms most of the public credit, but then if you're choosing the right managers, that it will really help to uplift another, a few points or a few percentage of where you're supposed to get in from the asset class as well. We have one question. The rate of return mentions that is it a net of fees?
Oh, yes.
Yes, so it's a net of fee of the Hamilton Lane fee. Like most of the time when they quoted a fee, target return is usually net of their management fee, net of their performance fee, if any. If my understanding correctly, that Hamilton Lane has removed the performance fee since early this year. So it's only like a one flat management fee. And then as Stashaway, we also have a very transparent fee models for different asset class. We are ranging from 0.2 to 0.8% for private credit, to private market investment. We are also ranging from 0.5 to like up to 2%. So this is also another area that you can also scan the QR code and reach out to our well advisor to find out more. Uh, Okay, so since Eileen has asked a very good question, since the funds are denominated in US dollar, will any tools be used to minimize the exchange risk?
So in this case, because it's a US dollar denominated fund, so we are not actually using hedging strategy. And at the same time, usually for longer term investments, the I I think people may see that weakening or strengthening as like very real at the moment as you speak. But if you are spreading out the investment over 2 or 3 years or 5 years, then actually we do think that the FX usually washes out, and therefore yeah, this is actually still pertaining to a mainly US dollar exposure there.
Green, this is a very good topic. You know, we because as us based in Singapore, unlike our audience in Hong Kong, the FX does move from time to time. But then I think we were discussing this topic with our CIO. So we're looking at the yes, recently Sing dollar has been strengthening. Then if you're looking at investing into US dollar terms investment, then it looks like that you're gonna lose out from the FX. But for a long-term investment, if you look back, right, we are looking at the US dollars against in dollars. In the long term, actually, it have some rates from slowly that it will move back to a certain level that you realize that the currency movement kind of negligible. So we do actually, that is exactly why you wanted to sit down with your wealth advisor and really plan in terms of the amount of this investment, whether it's for medium term, long term, or short term, and then they'll be able to advise. That's not necessarily from Stashaway. It could be from anywhere. That would be making sure that you are positioning your investment to the right, financial goal. So I guess really have a very good session. I feel today we have a very good questions. We're a very attentive audience. Thank you so much for Corinne for your insightful presentation one more time, and then and all of you for joining us this evening. And if you have any further questions or would like to explore how private credit or other alternative investment that may fit into your portfolio, or in general wanted to understand a little bit more about Stashaway, do feel free to reach out to any of us in our team, scan the QR code, write into us, and then we are happy to answer any of your inquiry or questions. And I think we hope you find today's sessions informative. Um, is there anything from you, Corinne?
No,
Oh,
pleasure to be
okay.
here. And again, thank you everyone for investing 1 hour of your time for your own knowledge and education. Thank you.
Indeed, indeed, indeed. Thank you so much for everyone. We look forward to having you for our next webinar on other topics. Have a wonderful evening.
Thank
Good
you.
night.